Welcome to our May 2026 update on the evolving landscape of urban air mobility. Today, we focus on the intensifying competition between the industry's two primary frontrunners, Joby Aviation and Archer Aviation. As both companies transition from rigorous prototype testing into pre-commercial operations, we find ourselves at a critical juncture in the race to commercialize electric vertical takeoff and landing technology. Before we proceed, please note that this presentation is for informational purposes only and does not constitute financial advice. We encourage all stakeholders to independently verify facts and assess risks before making investment decisions. At a high level, while both Joby and Archer are sprinting toward a commercial launch in the latter half of 2026, their foundational strategies differ significantly. Joby Aviation operates as a vertically integrated entity, maintaining end-to-end control over hardware, software, and its proprietary ride-sharing service. Conversely, Archer Aviation has positioned itself as a high-volume supplier, leveraging strategic partnerships with Stellantis for manufacturing and United Airlines for distribution. This divergence in operational philosophy sets the stage for a unique market showdown. Financial transparency will be in the spotlight this month as both companies report their first quarter results for 2026. Joby Aviation, reporting on May 5th, enters this period with strong momentum following a 2025 revenue of over $53 million, largely supported by defense contract. Archer Aviation follows on May 11th. While still largely in the pre-revenue phase, Archer has significantly bolstered its balance sheet with a $2 billion liquidity cushion, providing the extensive financial runway necessary to reach the commercialization milestone. Comparing their financial positions further, we see a clear distinction in their fiscal strength. Joby leads the sector in actual revenue generation, providing a tangible financial foundation that validates its operational model. Archer, however, dominates in terms of raw liquidity. Its $2 billion reserve, which doubled year over year, reflects strong institutional conviction and provides the capital necessary to fund its aggressive factory build-out in Georgia and its ambitious international expansion. The Gulf region has become the premier international battleground for these eVTOL pioneers. Joby has officially reconfirmed its Dubai air taxi service for the second half of 2026, utilizing its Elevate OS platform in partnership with Uber to manage end-to-end logistics. Archer is pursuing a similar timeline with its UAE pilot program. While Joby may hold the first-mover advantage in the partner ecosystem, Archer's competitive edge lies in its potential for manufacturing scalability, supported by the massive capacity of its Georgia production facility. In the United States, the regulatory environment continues to shape the competitive field. While Joby maintains a lead in the technical aspects of FAA-type certification, a landmark federal development in early 2026 has provided Archer with a strategic tailwind. The White House's selection of Archer's partners for the Federal Integration Pilot Program establishes a direct pathway for commercial domestic flights by late 2026, offering a structural advantage in navigating the complex U.S. regulatory landscape. When we examine their milestones side by side, the contrasting bets made by each company become evident. Joby is deep into the FAA-type inspection authorization process and is operating conforming aircraft. Archer, meanwhile, was the first to achieve full acceptance of its means of compliance and boasts a staggering $6 billion committed order backlog. Effectively, we are witnessing a competition between Joby's operator model and Archer's supplier model, each with its own path to market dominance. To use a technology sector analogy, Joby follows an iPhone model of vertical integration, prioritizing premium pricing and an airtight ecosystem, albeit with higher capital requirements. Archer adopts an Android model, partnering with industrial giants to achieve rapid, automotive-scale output. The ultimate winner will likely be determined by the market's evolution. If the sector demands a luxury, integrated experience, Joby is well positioned. If volume and rapid commoditization lead the way, Archer's manufacturing-first approach may prevail. Beyond operational data, two critical wildcards are influencing investor sentiment. First is the active legal friction, as Joby's 2025 lawsuit against Archer regarding trade secrets remains a factor for risk assessment. Conversely, there is a visible institutional shift toward Archer, with major entities like Vanguard and Sumitomo Mitsui increasing their stake. This accumulation suggests that sophisticated capital may be betting on Archer's ability to bridge the valuation gap through its manufacturing scale. In summary, choosing between Joby and Archer involves choosing between two distinct investment theses. Joby represents the proven leader with established revenue and a proprietary platform, while Archer offers a compelling growth story centered on high-volume manufacturing and a massive order backlog. As we look toward the second half of 2026, keep a close watch on the upcoming May earnings reports and FAA certification milestones, as these will be the primary catalysts for the next phase of urban air mobility.